I'll be helping you to solve this sum till passing journal entries, right? So I request you to post into ledgers and prepare trial balance simultaneously, right? So first have the properties of journals: date, particulars, ledger folio number, debit amount and credit amount, right? Have a table and start with the date 2015 March 1. Bablu started business with cash for rupees 60,000. So now we have two accounts. One is cash account and the other one is Bablu capital account. So cash account is real account. Bablu's capital account is a personal account. So cash debit what comes in, capital, Bablu's capital is a personal account, credit the giver. So accordingly the journal entry would be cash account debited to Bablu's capital account, rupees 60,000. Write the narration being Bablu started business with cash. Next, journal entry 2. March 1. Bought goods for cash rupees 10,000. Now again two accounts we have. One is goods purchased account and cash account. So goods purchased is a real account. Cash account again is a real account. So goods purchased, debit what comes in. So when you buy goods, goods comes in. So debit what comes in, you need to pay cash. So cash goes out. Cash again real account goes out. So credit what goes out. So goods purchased account debited to cash account, rupees 10,000. So here we discussed in class, right? You remember goods purchased account can be written as purchases account. Goods sold account can be written as sales account. So here you can rewrite the entry as purchases account debited to cash account, rupees 10,000. Next, journal entry 3. On March 3rd, purchased furniture for cash rupees 25,000. So here furniture purchased account debited to cash account. So as like in the previous transaction, it's same, but there goods purchased, but here asset furniture purchased. So this furniture purchased account you no need to convert as purchases account. Only goods purchased account can be treated as purchases. Goods sold account can be treated as sales. Whereas furniture purchased account can be treated as furniture account. That's it. So furniture account debited rupees 25,000 to cash account, 25,000. Being furniture purchased for cash. Next, transaction number 4. Journal entry 4, March 4. Purchased goods from Peter, rupees 15,000. So we can assume that it is on credit since name is there. Right? By giving the name, if they say is on cash, so we no need to take the name. But here it is on credit, right? Since name is given. So goods purchased account, one account, then Peter account, second account. So goods purchased account is a real account, Peter account is a personal account. Real account rule, debit what comes in, purchased goods, when you buy the goods, it comes in. So purchases account debit, and then personal account, credit the receiver. So Peter is the receiver or giver, credit the giver, that's right. So Peter is the giver, credit the giver. So goods purchased account, debited rupees 15,000 to Peter account, rupees 15,000. So as I said earlier in the March 1 second journal, goods purchased account can be treated as purchases account. So purchases account debited rupees 15,000 to Peter account, rupees 15,000, being goods purchased from Peter on credit. Next, transaction 5, March 5, sold goods for cash rupees 20,000. So here cash is real account, goods sold is a real account. So cash account, debit what comes in. When you sell goods, cash comes in. So debit what comes in. So cash account have to be debited. Goods sold account, when you sell goods, goods goes out. So goods sold account is credited. So as I said earlier, goods sold can be converted as sales account. So you can rewrite cash account debited rupees 20,000 to sales account, rupees 20,000, being goods sold for cash. Next, transaction 6, March 6, sold goods to Shamir. So since name is there, you can take this as credit, this transaction on credit. So we have Samir account and goods sold account. Samir account is a personal account, goods sold account is a real account. So Shamir debit the receiver. When we sell goods, he is the receiver. Samir is the receiver. So Shamir account debited to sales account, goods sold account or sales account, rupees 18,000. Right? The goods sold account is a real account. Credit what goes out. When you sell goods, goods goes out. So Shamir account debited to goods sold account or sales account, rupees 18,000, being goods sold to Shamir. Next, transaction 7, March 7, paid cash to Peter. Already we goods purchased from Peter on March 7. Now we are paying cash, rupees 14,500 to Peter. So now what we need to do, cash account and Peter account, two accounts, right? Cash account is a real account, credit what goes out. So because cash goes out to, it goes to Peter, right? It goes to Peter. So it is credit what goes out. Peter is a personal account, debit the receiver. So Peter account debited rupees 14,500 to cash account, rupees 14,500, being paid cash to Mr. Peter on account of purchases made on March 4. Right. Next transaction number 8, March 9, received cash from Shamir. We already goods sold to Shamir 18,000. Now we received cash from Shamir, rupees 17,000. So what happens here? Cash account and Shamir account. Cash account is a real account and Shamir account is a personal account. Cash account, real account, what is the rule? Debit what comes in. When we receive cash, cash comes in. So debit what comes in. Shamir is a personal account, credit the giver. Right? Shamir is a personal account, he is giving us cash. So he is the giver. So credit the giver. So journal entry would be cash account debited to Shamir account, rupees 17,000, being cash received from Shamir. Next, paid wages of rupees 1,300 and salaries of rupees 2,200. So there are two transactions in the same date. So let us treat this as a two separate transactions. So paid wages, wages account and cash account. Paid salaries, salaries account and cash account. So the entry would be wages is a nominal account, debit all expenses and losses. Wages is an expenses we are paying. So it is a debit, we have to debit. Cash account is a real account, credit what goes out. So the entry would be wages account debited rupees 1,300 to cash account rupees 1,300. Next, salaries. Likewise same thing. Instead of wages, here salary. So salary account debited rupees 2,200 to cash account rupees 2,200, being salary paid on March 15. Next, March 20, received commission rupees 850. So received commission means we have two accounts. One is cash account, the other one is commission account. Here cash is real account, debit what comes in. So when we receive commission, cash comes in. Right? So debit what comes in. Commission is a nominal account. Credit all incomes and gains. Since we are receiving commission, commission is an income now. Right? So credit all incomes and gains. As per the rule, we have to credit the commission account. So the entry would be cash account debited to commission account rupees 850, being commission received rupees 850 on March 20. Next, March 22. Withdrew cash from office for personal use. Who withdraws? The owner withdraws. Owner withdraws cash from business for personal use. So here we have two accounts. Cash account, already proprietors we have one account called Bablu's capital account. Do you remember that? Yeah, yes. So withdraw cash from office for personal use. So cash account and Bablu's capital account. Here cash account is a real account. Credit what goes out. Now cash is going out because owner is getting money, taking money from business. So from business point of view, cash goes out. Right? So credit what goes out. Cash have to be credited. Next, Bablu's capital account. Bablu's capital account is a personal account. Credit the receiver, debit the receiver, credit the giver. Am I correct? The rule. So here Bablu's capital. Bablu is receiving the money from office for his personal use. Right? So it has to be debited. Debit the receiver. So Bablu's capital account debited rupees 2,500 to cash account, rupees 2500. Here a small change we need to make. When a proprietor receives money, when the proprietor takes back his money from the business, when he invests into the business, it's called capital. When he takes back from the business, it's called drawings. It's called a drawings account. Please make a note. But while passing journal entry, to put that rule, we need to use Bablu's capital account. But while writing the journal entry, correct journal entry, instead of capital, we can use the drawings account, Bablu's drawings account. So I will rewrite the journal entry now. Bablu's drawings account debited rupees 2500 to cash account, rupees 2500, being withdrew cash for office, from office for personal use. Next, March 22, paid rent rupees 900. So we have two accounts, rent account, cash account. So cash account is a real account, credit what goes out. So cash account have to be credited. The rent is a nominal account, right? Debit all expenses and losses. So we have to debit rent account. So entry would be rent account debited rupees 900 to cash account rupees 900. The last transaction, March 31, received interest rupees 300. Right? So now received interest is an income. Right? So we have two accounts now, interest account and cash account. Interest account and cash account. So as soon as we receive the interest, so what happens now? Right? So cash account is a real account. Debit what comes in. When you receive interest is not coming, cash is coming. So debit what comes in. Interest is an income, a nominal account. So nominal account rule is credit all incomes and gains. So as interest is an income, we have to credit all incomes and gains. So the entry would be cash account debited rupees 300 to interest account rupees 300, being interest received for rupees 300 on March 31. I hope you understood, and you can pass the journal entries. So simultaneously I request you all to post into ledger accounts and prepare trial balance. Come with the answer tomorrow. Have a good day. Thank you.